The Bank of Canada will make its next decision on interest rates tomorrow. Despite a recent strong jobs report, most on Bay Street expect the central bank to stay on hold. In fact, with higher borrowing costs threatening the economy potentially towards a recession, a rate cut is being priced into the market by the end of this year. For his take, Jean-François Perrault joins us now. He's chief economist at Scotiabank. Thanks so much for making time today.
Well, thank you.
So what are you expecting to hear from the Bank of Canada tomorrow? We've got the rate decision. We've also got the monetary policy report to go through. But when it comes to that decision, do you think that the bank will stick with the pause for now?
I mean, I don't see any reason for them not to, right? You are looking at a situation where inflation has been coming down. It's still extremely high, but it's been coming down. So roughly in line with how the Bank of Canada was thinking. And of course, we've got jobs data and so far economic activity data for the first quarter, which are actually pretty strong. So if anything, going into this meeting, it's less a matter of, what are they going to do in terms of the pause, but more, are they going to be shading their message to acknowledge that despite what's happened in the U.S. banking system, that the risks, in fact, might be tilted to the upside. So rather than a potential cut as we go forward, maybe they'll signal that they might need to do a little bit more, at least some caution with that respect, because as you might know, the market's actually expecting or pricing in a probability of a cut at of the meeting tomorrow.
Yeah, it is a really interesting time. We were talking about the IMF cutting its global growth forecast. But when it comes to Canada, the economy is proving to be quite resilient, at least to start this year. How surprising has that been from your perspective?
I mean, listen, it's been the story of the last 7 or 8 months, right? Folks like us have been anticipating a slowdown to occur. The Bank of Canada has been anticipating a slowdown to occur for many, 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 many months now. And sure enough, as those months go by, these predictions that we have that things are going to slow in a meaningful way tend to not materialize, particularly when it comes to the labor market. So as a result of that, you've had, the Bank of Canada over last year raise quite a bit more than we would have thought a year ago, just by virtue of the fact that the economy has just managed to defy expectations time and time and time again, including so far this year.
So have we, just sort of kicked the possibility of a recession down the road, or are your expectations for what we might be going through changing? Will it potentially be a recession? What are you thinking?
Well, we're still thinking there'll be a recession. We think the weakness starts in the second quarter. So, the next month or two, maybe some of the data will come in for March that's a little bit weaker. I mean, there is every reason to believe a slowdown will occur. There's no question about the timing. But, you have to look at, for instance, what's happened in the U.S. financial system as, maybe a more concrete indication that things are more likely to slow sooner rather than later, which means that a recession call, if in fact a recession occurs, might be, a reasonably imminent development in both Canada and the U.S.
How do you see that playing out for the labor market? Because that also has just proven, to be surprisingly strong in Canada, month after month of gains. I think it was 7 months in a row now of gains for the job market, and many surprises to the upside along the way there. Can that continue?
Well, it shouldn't continue. We've seen, over 200,000 jobs created so far this year. It's only 3 months. It's extremely robust. Now, we know that labor is a lagging indicator, right? So it takes a while for the labor market to slow once the economy itself is slowed. So we do expect a lag. That being said, when you look at vacancies, when you look at surveys from firms, basically asking them, are you happy with the amount of workers that you need? Do you need more? Are you having a hard time finding more? All those suggest that there is greater resilience in the labor market as firms still are short workers. So, this typical lag that we still expect to see. Some slowdown to occur, but that slowdown is likely to be, when it happens, a little bit less aggressive than we would normally see in a cyclical slowdown, just by virtue of the fact that firms are still by and large starved for workers.
What's your sense of the health of the Canadian consumer right now, JF? Because we were looking at a survey earlier today from MNP done by Ipsos, and it was showing that there's concern out there that the worst is yet to come for the economy. And I mean, that kind of lines up with what you're talking about as well. But, you know, when it comes to the consumer, how well do you think they'll be able to manage through that?
Well, listen, I mean, the hard part of being a central banker, right? The governor's job is he's trying to slow the economy. And to slow the economy, you need to create a bit of pain. And that means that households, some of which are struggling now, are likely to struggle more going forward, right? If we do have a recession, if there are job losses, if job growth slows, that is going to hurt households. By design, this is not an accident, right? This needs to happen, or this is being kind of triggered. So we do expect a little bit more hardship going forward. There's no question about it. That, in addition to the fact that it takes a long time for the full impact of monetary policy to be felt, right? So the rate cuts that were done late last year, middle of last year, are probably not being felt to their full extent now, and that will, of course, continue to build as we go through the year and maybe into next year.